Welcome to episode 239 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. And Nick, I got a question for you. It's when am I going to be able to buy a house at a really low interest rate?
Well, Jace, I've got bad news for you. Interest rates are not going to be low, or at least for this foreseeable future. I'm not going to say ever again because we could have another pandemic. But days of the 2 to 3% interest rates are gone. People need to get used to the new norm, which is probably going to be somewhere around 5%. Interested to hear Marty's thoughts on this because he's an economic guru. Loves reading stuff on the economy. 5%, Marty, do you think that's the new norm?
Well, there's bigger issues here. The ticket for the MCG for the cricket has just doubled. How does the ticket double in price from last year? I know it's the Ashes, but they said they've got to double it because the costs are, a problem.
We've just come off an episode about value pricing. Maybe they've just gone, we can sell this joint out even if we double the price. Let's make some more money.
Now mix that with a 5% interest rate.
Funny you bring that up, Marty. I got an email today. This is completely sidetracking. I've just been accepted as a provisional member.
Oh, congratulations.
2009 entrance. So
well done.
14 years later. Provisional. So it means I'm still a hack. But
No. You will enjoy the perks of provisional. And not to top you, mate, not to top you, but I got an email and I'm a restricted member as of August. I'm so excited because I get to go to the Anzac Day clash and I get to go to the day one of the Boxing Day test, which I've missed out on. But I was in there for 5 years, Nick, as a provisional. So, But it's getting shorter. I think with COVID,
so what does this mean?
Everyone's dying quicker.
It's actually it's interesting if we talk about our last episode in creating value. You've got a 14-year wait list to be provisional, another 5 years to be restricted, which I assume means you sit behind a pylon or something and you can't see anything. So it's a good way to create value. Put your name down. You should get a look in about 20 years.
You know what? There's that many numbers to unpack in that. Let's park that for a future episode of the numbers around MCC and even our AFL membership. I'm silver. I want them to be gold. So park that thought. Let's come back to the numbers around that because that is exciting. But
I think 5% is where like you said, Nick. I've been doing a lot of reading, but I feel like it's there's no way we're going near to those low rates again unless something drastically happens. I think inflation will be in check. They won't want to drop rates and have that spark up because if it did, it could pose a real problem that would be harder to turn around again. So I think it's a softly approach. And like I've always said, you want to take action from where the market is at because you can't control what the market is going to do. You've got to come back to your own market and do what you can do given the circumstances. Otherwise, you're always waiting for something else to happen to make a move. 100%.
Well, I just wanted to give people just some background on why we think that and what the experts are saying. And, we're sitting here saying, oh, well, it'll be 5% to control inflation, but what does that really mean? How do they come to 5%? So the important thing is when we talk about interest rates, we're talking about you and I now at 5%. We're talking about the end consumer, their home loan rate. So, Jace buys a house. What home loan rate is he paying? Let's say it's 5%. When we're talking about the RBA, we're referring to the cash rate. So I think the cash rate at the moment is 3.85. Is that right? After the latest drop, we're recording this around the new financial year in 2026. So generally, a home loan rate will be around 2% above what the cash rate is, maybe a little bit less, just depending on a few different variables. So when we're looking at prediction on interest rates, we're looking at that cash rate. Where's that cash rate going to sit? And what is the proposed neutral cash rate or Goldilocks cash rate, as it can be referred to? Jace, you're a smart man. The Goldilocks cash rate?
3%.
Well, that's what the experts say. But the What I was asking was, what does it mean?
Oh,
It's a cash rate, which then will influence an end interest rate to a consumer
mhm.
that they feel will keep everything in check. So it will control inflation. It will ensure there is still investment and growth in economies, and it will also ensure that people can maintain savings. So it's this perfect rate where everything just stays stable.
So Nick, just to confirm, I mean, from my point of view, is Goldilocks rate similar to the neutral rate? Is that what they're describing?
Yeah, one and the same. Just
okay.
just another way to say it. So if we're looking at that cash rate at the moment, it's 3.85. You mentioned the predicted Goldilocks or neutral rate at about 3%. The issue at the moment is it's predicted, and the RBA has models out there that suggest that neutral rate should be 3.9%. There's other models that suggest it should be 0.7. So there's this big variance in what it should be, but what markets are saying is it's going to be higher than what it has in the past, and there's a few reasons for that. One of the reasons is government deficits. So it's like supply and demand with money. Governments are lending all this money, right? And they're more than content to go into higher deficits, which means there's more need to lend money. A lot of investment in AI, a lot of investment in green energy, the shift to green energy.
Yeah, for
so
sure.
all this stuff's going to cost a lot of money, and which means less and less savings, which means the demand for these monies to lend goes up. So we're looking at that Goldilocks rate sitting around 3%. Let's say there's another 2 to 3 rate drops on top of what we've got at the moment. People now would be paying somewhere between mid-5s to 6s on their home loans. They probably need to get used to high 4s to 5s on their home loans, maybe a little bit more for an investment loan. So I guess what I'm encouraging people to do is just think about that, and when they're making decisions, long-term decisions on their future, buying houses, buying cars, these sorts of things, they need to factor in that kind of interest rate. And if they're going to be conservative, they probably need to factor in an interest rate higher, because the stuff that I've been reading around what's going to drive this neutral rate up, the investment in green energy and AI, those costs are just going to go up. It's crazy, the government deficits that we're seeing. So I don't see anything that's going to make it better. So for me, I'm thinking, well, geez, I'm going to make sure that things are okay at 6%. Not so much 5%, because I don't like the way things are going at the moment based on governments and some other global trends that we've got.
Yeah, and I guess in the past, sort of, we've been sitting, like I remember in the 2000s, sitting at 5.75s quite consistently around that area, as those 6s. It was just the norm, but obviously property prices were a lot lower. So it's the impact was very different. But I guess when people are thinking rates are coming down, property prices are going to boom, not necessarily the case. And for every rate cut, maybe you get an extra 40 grand of capability in what you can borrow up to, and we might be capped out at an extra 100 grand. So this this boom or bust mentality, I think it's probably, like you're right, somewhere in between, and we just have to make. You're always better to be a bit defensive and like you say, like dictate everything on 6% just to be safe, because you just never know what happens. Well, we never would have thought rates would have come down to 2 either, right? But we sure as hell didn't think they'd go up 14 times. Well, I don't think we'll get either or now, know. So it's just a new frontier.
And I think the challenge is now that COVID was 5 years ago, so that was the reason why rates did what they did. So there's a lot of the population that are in the position in life, or the life cycle or stage of life where they're borrowing, that have only seen those in that environment. So you picture someone in their early 30s, bought their first home in their mid 20s or late 20s. They only saw 2 to 3%. Then they've obviously experienced this increase in rates. So there is an expectation that it'll get back to what it used to be like, but what it used to be like wasn't that 2 to 3%. That was a pandemic. That was a black swan event. what it used to be like is people like you and I, Marty, who have been around a little bit longer, and we've seen 5s and 6s. We know what's normal because that's what it always was. So I just think, there might be this assumption that, even I've heard 4%. People think, oh, yeah, it's not going to get back to 2%, but it'll probably sit around 4%. I don't think it will. I just don't think it will. So these are the things that we are hearing amongst our clients, but I think 5 is what people need to get used to paying.
Look, we joke around about the cricket tickets and things, but again, the other thing people are dealing with is obviously the cost of living increases are quite dramatic from even 5 years ago. So you've got that double compounding effect where a lot of money's coming out of people's pockets. And, I don't want Jace to get to the point where he has to be running around with machetes in the street. But I go, I know you would never do that, Jace, but I'm going, but this is what's happening. You're bringing more people into the country. There's more demand and need for housing, but affordability is a real problem. I mean, you need people earning great money to be buying the average property in Melbourne, Sydney, or Brisbane. And yes, you can go rurally, but that doesn't always match up with what people want. So it's a real concern, and I'm not sure what the solution is at the moment, and maybe it's got to play out a little bit more, but energy costs going nuts, affects businesses and people.
So that's probably one of the other ones. We had Brian Parker, he's the economist at Sun Super. He presented to us a few weeks ago just on all things economics and macroeconomics and right down to, but when you've got an inflationary environment where inflation, cost of goods is still been quite steady, it's on the up, the ability to pull interest rates back, that lever that happens. One of the major issues is around government spending, which Nick, you touched on a little bit too, but the government's putting such an investment into roads, defense, green energy, AI, health, so on and so forth. When you think about the salaries that a lot of these workers are on when they're doing these government projects, they're big incentive salaries to come and do those projects. What that's meaning is if we're letting in heaps of people into the country, that then we have a home affordability issue. We're not building enough homes. But then we also don't have enough skilled workers to build those homes because they're all jumping onto other projects for the government where they're on a big dime. So we have a supply issue where now we've still got house prices are an all-time high and they're never going to come back, or, they're not pulling back. They're going up more than ever. We talked about the price in Melbourne, what's going to happen to property prices. This is all fueling that idea that we're never going to get back to the glory days of 2 or 3% mortgage rates because they just can't pull the lever to do that. While we have such other issues around supply in homes, too many people coming into the country that need a place to live, and a massive undersupply due to not having people out there building homes. So, from my point of view, and a lot of the conversation in that chat was government needs to intervene and make, developments more promoted, more of a thing that we should be doing, medium density living where you got 4, 5, 6-story developments in not regional, but inner city or suburban kind of areas where, we're so used to trying to have these 500 square meter, properties, 4-bedroom, double car garage brick. The mindset needs to change if we're going to be able to create affordable housing and affordable living where we don't have the big property, the big land component. Something's got to shift.
It's all going to be apartments, and that's what you're seeing going up and building projects everywhere.
I think the issue is, and not to go down a rabbit hole because we could. I think the mindset shift is there. There's definitely, talking about our country in particular, there's definitely pressure on from state to local councils on what's approved. They're definitely rezoning areas from maybe medium to high density, but to your previous point, it doesn't change the underlying issue around compliance and cost to get things built. And ProBuild's just gone broke again after someone tried to save that. It's the numbers don't stack up. So you can have the mentality that, oh no, we need to build more smaller stuff. But if the numbers don't stack up because of your cost of goods and your weight, particularly your labour, and a lot of that's driven by compliance as well, what compliance boxes have got to be ticked. No developer wants to put their hands in their pocket to do it because it's too risky. Like, why would you risk that amount of money?
It's funny you say that, Nick, because I was talking to a builder about a week and a half ago, and he was saying that they've stopped building new homes because it's timely, It's costly. The prices can vary from start to finish. So they're just going in on renos because the infrastructure's set up. They can do a quick turnaround. They get bigger margins. So even builders, and particularly those medium density and builders, are sort of making different business decisions where they can get in and out of projects really quickly because it's just not worth their while, and people aren't willing to pay the big ticket stuff. So whether the government's obviously taking on those type of builds, in the future, but yeah, even the builders are making different decisions because otherwise they end up like ProBuild, right?
Yeah. Nick, if there's anyone out there who, was kind of banking on rates continuing to come down, if we are saying that the mindset needs to be to get used to rates somewhat similar to where they are, maybe one or two more drops. If they're concerned about their situation, they think affordability is becoming an issue. Maybe they were going to start a family or have another child into the family. Should they be fixing? Should they be reviewing their rates? What are the options, the tangible, actual, actionable things they can do?
I've never been an advocate for fixing. The reality is the bank doesn't give you a rate thinking they're going to lose. That's the best way to explain it. And the only time I've ever seen fixing, people win with fixing is when there's a crisis. So, if you fixed during COVID, no one saw what was going to happen post that, as in, how quickly we're going to bounce back in the increases. So in a normal market, you would never fix. That's general advice only. But if you were, for some people, it's not about rates. For some people, it's about being able to sleep at night. So if you're stressed and you want to ensure that your rate's not going to go anywhere for 2 years, it might cost you slightly more. You're never going to know because you don't know what the variable rates are going to do. But for some people, they're happy to pay a little bit more for certainty. So, I think it's it very much depends on people's circumstances and what's happening as to whether or not they're fixed, and we can give them guidance on that. Other than that, it's just, you've really got to realign your expectations based on what's happening. So, we talk about doing budgets for businesses, and we also say you should do your household budget, but sit down and actually do it. Sit down and do it. Sit down and understand, okay, if I bring a child into the mix or another child, what does that do childcare-wise? How does that impact my wife's ability to work during the pregnancy? What are we going to lose from an income point of view? Actually map it out. Is this house suffice? Do we need to renovate it? If we renovate it, what does that look like? Can we afford that? Do we need to find another area because this house won't be big enough? So, we go back to run the household budget like you do your business, and we kind of do that automatically because we're in business all day. So,
yeah,
I don't sit down with a spreadsheet on the household budget. I definitely don't do that. I'm not saying I do that, but I've got a fair indication of what needs to occur and what moves need to be made and whether or not they're going to be, achievable.
Yeah, and on the back of that budget, that's the first step to minimize your expense. But talk to a broker at Innovate and talk about how to pay down debt. The best interest rate cut you could ever have is use surplus income to pay debt down, and that's going to better your position more aggressively than anything. So don't just utilize it for a great rate. You're going to get that. But you want to start looking at some strategy even before having kids. It might be it's a year before we have kids. Go all in, double income, really tighten the belt up and try and deleverage debt to get yourself into a stronger position to make those decisions after the budget as well. So again, a little bit more foresight and planning can really set you up for the future if you do it well.
One more question from me, Nick. For anyone out there who has a mortgage, they've bought a home at some point in the last 5 to 10 years, how often do you recommend doing a review of their rate?
Annually. So we automatically do it annually here. To go a bit deeper on that, the market has changed a lot. So, there has been some refinance frenzy time periods over the last 4 or 5 years. So I think like most of our clients, and I'm sure most of our competitors' clients, they're on really good rates now, and banks will really price to retain. But you should ask the question to your broker or your bank annually. Doesn't mean you need to move. You might just have to ask the question and make sure your rate is a market rate.
And if you are doing a good job in your job, don't be afraid to ask for a slightly higher wage. if you're doing a good job, if you're floating, don't bother. But if you're doing a good job, business owners are not going to want to lose you, right? So again, you're thinking about how do you move the needle in a direction that's going to serve you across the board. That's what Nick's talking about. It's holistic thinking, not just reactive thinking and going, holy crap, I'm in trouble.
And look, it's a little personal shout out as well to Luke Mace at Innovate, not just the mortgage broking team, but if you are working with a financial advisor as well, one thing to have great business budgets and great business forecasts, but often, I don't know if you know the saying, the mechanic's car is the worst car on the road. When it comes to personal finances, there wasn't necessarily as much of a strategic plan for myself and Case. And recently, Macy sat us down and said, this is a non-negotiable. You're doing the budget. This is what's going to happen, because he wanted to extract out the extra things we were missing, the things we could do differently to fast track getting ahead, to fast track that property acquisition. And now actually having gone through, I've half-assed step one of the process of actually filling in that financial budget spreadsheet, but I've done a fair bit of work on it and circulated back to Luke, but he's booked in that quarterly meeting to keep us accountable to our goals. So for me, I'd say, beyond, having a mortgage and checking your rate, actually doing that budget. We've stressed and banged on about it before, but I finally myself have sat down and put myself through what we recommend our listeners do. And it is eye-opening. Like,
it's scary when you first do it.
It's just to, and again, we know these things are like subscriptions, just the little things that you bleed sometimes. But, between Case and I, we had a Disney and a Stan and a Netflix and a this. It's like, God, we don't have time to watch TV. Let's cull a couple of them. So, if you're out there and you're listening, the rates are one thing, but, like what you said, Marty, if you can squeeze an extra $100 a week or a fortnight or a month, whatever it is, onto your mortgage, that has a massive impact on how much interest you pay over 20 or 30 years. So find that extra $50 or $100 could be a game changer as well.
I'm just taking a note here. Check Jason Robertson's fee. Definitely thinks Luke adds value. So just make sure it's based on value, not ours.
But Jace, you would have picked up like you're talking about. It's like those incremental. It doesn't have to be a lot, but even that compounding effect of putting extra $100 into super every week, every fortnight, it all adds up to a better future, and puts people, gives people certainty because they've got a plan and they know where they're heading.
Clarity, certainty, and a plan. Those words just kind of jump out at me. I go, for Case and I to see now where we're going, what the numbers look like, rather than, the week-to-week money hits the account, cool, no worries. Now we're looking at, well, what happens if we kind of run that out? And what happens if Casey's salary does this and future advisory does that? Okay, wow, we can do some pretty cool stuff. Like let's get excited about that future position if we're smart with our money. If we're not, it looks very different. So yeah, I think that part of having a plan to map out how that looks is really important. But, part of this conversation too is around changing the mindset, thinking that cheap money is a thing of the past, and not saying this is Case and I's mindset, but if we were sitting back going, we'll just play the waiting game, interest rates will come down or property prices will come down. There's people who sit on the sidelines playing the waiting game. The message now is you can't play the waiting game because the rates aren't going to be coming down to the level where they were before. So start to think about how you can change your mindset to make sure that you're ready for the environment that we're in and creating a long-term strategy for this new environment.
Absolutely.
Well, thank you for listening. Nick, great conversation, great topic, and one to really unpack. So I've loved it. If you've also loved listening to this episode, please, like usual, subscribe, give a rating, send an episode to a friend. We absolutely love growing our numbers game community. So get around us. Until next time.
Numbers don't just tell a story. It's reality. Make your move. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.